Welcome back everyone. Today we are going to unlock another chapter of our accounting course that will make accounting easier to understand. The title of today's class is Conceptual Framework of Financial Accounting. This is the second chapter of your course outline. In this chapter, we will cover some very important topics. We will start with an introduction to accounting. Then we will discuss the needs for financial records and why they are essential. Next, we will look at the users of accounting information and how they use it. After that, we will move on to the conceptual framework of accounting information. We will also study the key elements of financial statements, followed by a discussion on ethical issues in accounting. Then we will go through the stages of accounting cycle. And finally, we will end this chapter with the idea of integrated reporting, which connects financial and non-financial information together. So let's start. You know, accounting information is crucial for both businessmen and investors to make informed financial decisions. A businessman needs accounting information for internal decision making and operational management. It is the primary tool for budgeting, forecasting, and controlling costs to ensure the business is profitable and efficient. By analyzing accounting data, a business owner can evaluate performance, set pricing strategies, and identify areas for improvement. This information is not just about tracking money, it's about steering the company towards its goal. On the other hand, an investor relies on accounting information for external analysis and investment decisions. They use a company's financial statements, the income statement, balance sheet, and cash flow statements to assess its financial health and performance. This data allows an investor to determine a company's profitability, liquidity, and solvency. Ultimately, accounting information provides the essential data for valuing a potential investment, assessing its risk, and deciding whether or not to commit capital. So next issue is users of accounting information and their needs for accounting information. In a broader perspective, users of accounting information can be categorized in two different segments. One is internal users and another one is external users. Management, employee, and unions and board of directors are considered as internal users, and investors, shareholders, creditors and lenders, government and regulatory agencies, customers and suppliers, and public are external users. As internal users, management need information to make informed decisions for planning, organizing, and controlling business operations. These include budgeting, cost analysis, and evaluating performance. Employees and unions need accounting information to assess job security, evaluate the company's profitability for wages negotiations, and assess the ability to provide benefit like pensions. Similarly, owners or board of directors need accounting information to evaluate the overall performance of the business, assess management effectiveness, and decide on issues like reinvesting profit or distributing dividends. On the other hand, investors as external users, they also need accounting information to evaluate a company's financial health, assess its profitability, and decide whether to buy, hold, or sell shares. Creditors and lenders need information to assess a company's creditworthiness and ability to repay loans or debts. Government and regulatory agencies need information to calculate tax liabilities and ensure the company is complying with laws and regulations. Customers and suppliers also need accounting information to determine if a company is financially stable enough to provide long-term support or to pay for goods and services. The public need accounting information to assess a company's economic impact, social responsibility, and contribution to the community. The next topic to cover is conceptual framework of accounting. A conceptual framework has been defined as a constitution, a coherent system of interrelated objectives and fundamentals that can lead to a consistent standards and that prescribes the nature, functions, and limits of financial accounting and financial accounting statements. There are three levels of this framework. Let's start with the level 1 element. Level 1 define the objectives of general purpose financial reporting. As per the latest conceptual framework given by the IASB in 2018, the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. So existing and potential investors, lenders, and other creditors need information about the economic resources of the entity, claims against the entity and changes in those resources and claims, and how efficiently and effectively the entity's management and governing body have discharged their responsibility to use the entity's economic resources. So, this information should be provided through preparing the financial statements. Then level 2 of the conceptual framework comprises two issues. One is qualitative characteristics of accounting information, and another issue is the element of financial statements. There are two types of qualitative characteristics. One is fundamental characteristics and the other one is enhancing characteristics. Relevance and faithful representations are the fundamental characteristics, and comparability, verifiability, timeliness and understandability are the enhancing qualitative characteristics. As I have already mentioned, the first fundamental qualitative characteristic is relevance. Information is relevant if it has the ability to influence the economic decisions of users and is provided in time to influence those decisions. Information that is relevant has predictive value, confirmative value, and should be material. Predictive value enables users to evaluate or assess past, present, and future events of the entity, and confirmatory value helps users to confirm or correct past evaluations and assessment. And the third characteristic is materiality. Information is material if omitting it or misstating it could influence decisions that the primary users of general purpose financial reports make on the basis of those reports, which provide financial information about a specific reporting entity. Then the second qualitative characteristic is faithful representation. Faithful representation means the number and descriptions must match with really existed or happened. If information is to represent faithfully the transactions and other events that purports to represent, they must be accounted for and presented in accordance with their substance and economic reality. To have perfectly faithful representation, financial information would possess the following three characteristics. These are completeness, neutrality, and free from error. Here, completeness depiction includes all the information necessary for users to understand the phenomena being depicted, including all necessary descriptions and explanations. Then neutrality. Information must be neutral and free from bias. And third issue is free from error. Information must be free from error within the bounds of materiality. A material error or omission can cause the financial statement to be false or misleading, and thus unreliable and deficient in terms of their relevance. Then enhancing qualitative characteristics. I have already mentioned there are four qualitative characteristics. First one is comparability. Accounting information must be comparable. Users must be able to compare the financial statements of an entity over time to identify trends in its financial performance and financial position, and compare the financial statement of different entities to evaluate their relative financial performance and financial position. The second enhancing qualitative characteristics is verifiability. Verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. The third enhancing qualitative characteristics is timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decisions. That is, you should provide information timely. And last one is understandability. Classifying, characterizing, and presenting information clearly and concisely make it understandable. These are the qualitative characteristics of accounting information. The next element of level 2 is key elements of financial statements. There are mainly 5 key elements of financial statements. These are assets, liabilities, equity, income, and expenses. The first I will define assets. The conceptual framework defines assets as a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. The three components of the assets definition are: the entity must have control on the asset. This control has been achieved as a result of past events and from which future economic benefits are expected to flow to the entity. Assets may have physical existence or no physical existence. For example, land, it has physical existence, whereas patent, trademarks are example of intangible assets. Again, assets may be classified as current assets, for example, cash, inventory, and non-current assets also, for example, land and furniture. Next element is liabilities. Liability is defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of resources from the entity. So, the key components of a liability definition are the requirement for the entity to have a present obligation. Second is, as a result of past event, this obligation has occurred. And third one is, for which an outflow of future economic benefits is expected. For example, suppose you have taken a loan from a bank amounting taka 1 lakh. This is an example of liability. Based on maturity, liability can be classified as current liabilities and non-current liabilities. The third element is equity. Equity is defined as the residual interest in the assets of an entity after deducting all its liabilities. For example, capital given by the owners, share premium, retained earnings. These are the components of equity. Then next element is income. Income is defined as increase in economic benefits during the accounting period in the form of inflow or enhancement of assets or decrease of liabilities that result in increase in equity. The two essential characteristics of income are an increase in assets or a reduction in liabilities, and increase in equity. For example, you have sold products on credit. It is an example of revenue. Then expense. Expense are defined as decrease in economic benefits during the accounting period in the form of outflow or depletions of assets or incurrences of liabilities that result in decrease in equity. The two essential characteristics of an expense are a decrease in economic benefit that may arise through outflow or depletions of asset or an increase in a liability, and a decrease in equity other than those arising from distributions to equity participants. For example, you have paid the salary of your employee. It is an example of expenses. Then level 3 of conceptual framework, which is basic assumptions, principles and constraints. There are 4 basic assumptions. These are economic entity assumptions, going concern assumptions, monetary unit assumptions and periodicity assumptions. First, I shall discuss the economic entity assumption. Economic entity assumptions requires that activity of the entity be kept separate and distinct from the activities of its owners and all other economic entities. For example, ABC company records the company's financial activities separate from those of its owners and managers. From an accounting perspective, the business is treated as being separate from its owners. The second assumption is going concern assumption. The financial statements are prepared on the assumption that the entity is a going concern and will continue to operate for the foreseeable future. The normal expectation is that based upon current knowledge and understanding of the business, it is reasonable to assume that the business will continue to operate for the next 12 months. Note that there is no guarantee that this will always be the case, as evidenced by business failures and insolvencies. Depreciation and amortization policies are justifiable and appropriate only if we assume some permanence to the company. If a company does not use a going concern assumption, then planned assets should be stated at their fair value. In that case, depreciation of this asset is not needed. The next assumption is monetary unit assumption. Monetary unit assumption requires that only those things that can be expensed in money are included in the accounting records. This means that certain important information needed by the investors, creditors and managers, such as customer satisfaction, is not reported in the financial statements. And the last assumption is periodicity assumption. Notice that the income statement, retained earnings statement, statement of cash flows all cover periods of 1 year, and the balance sheet is prepared at the end of each year. The time period assumption states that the life of a business can be divided into artificial time periods, and that useful reports covering those periods can be prepared for the business. Next, I shall discuss the principles. There are also 4 principles. These are historical cost principles, revenue recognition principle, expense recognition principle, and full disclosure principle. First one is historical cost principle. GAAP requires that companies account for and report many assets and liability on the basis of acquisition price. This is often referred to as the historical cost principle. Generally, fixed asset like property, plant, and equipment is recorded according to historical cost principles. Nowadays, many companies use fair value for valuing the assets instead of presenting the asset at historical cost. Here, fair value is the price that would be received to sell an asset or paid to transfer a liability. in an orderly transaction between market participants at the measurement date. It is a price determined in arm's length transactions. Fair value information may be more useful than historical cost for certain types of assets and liabilities and in certain industries. The next principle is revenue recognition principles. When a company agrees to perform a service or sell a product to a customer, it has a performance obligation. When the company satisfies this performance obligation, company recognizes revenue in the accounting period in which the performance obligation is satisfied. The next principle is expense recognition principle. Expenses are defined as outflows or other using up of assets or incurring of liabilities during a period as a result of delivering or producing goods and or performing services. It follows then that recognition of expenses is related to net changes in assets and earnings revenue. In practice, the approach for recognizing expenses is let the expense follow the revenues. This approach is the expense recognition principle. And the last principle is full disclosure principle. Users find information about financial position, income, cash flows, and investment in one of three places: within the main body of financial statements, in the notes to those statements, or as supplementary information. In deciding what information to report, companies follow the general practice of providing information that is sufficient importance to influence the judgment and decisions of an informed users. Often referred to as the full disclosure principle, it recognizes that the nature and amount of information included in financial reports reflect a series of judgmental trade-offs. And finally, there are two constraints. One is cost-benefit analysis and another one is conservatism. The cost-benefit analysis means the cost constraint is a qualitative characteristic of useful information, which states that the benefits of providing accounting information should outweigh the cost of providing it. And conservatism means when there is uncertainty in the accounting transition, accountants should choose the option that is least likely to overstate assets and income and least likely to understand liabilities and expenses. This means that you should recognize losses immediately as soon as they are probable and delay the recognition of gains. Next, I am going to discuss about ethical issues in financial accounting. The International Federation of Accountants pronounced following fundamental principles as the core ethical code for professional accountants. These are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. First one is integrity. An accountant should be straightforward and honest in all professional and business relationships. Second principle is objectivity. A professional accountant should not allow bias, conflict of interest, or undue influence of others to override professional or business judgments. Third one is professional competence and due care. An accountant has a continuing duty to maintain professional knowledge and skill at the level required to ensure that a client or employee receives competent professional service based on current development in practice, legislation, and techniques. A professional accountant should act diligently and in accordance with applicable technical and professional standards when providing professional services. The fourth principle is confidentiality. A professional accountant should respect the confidentiality of information acquired as a result of professional and business relationships and should not disclose any such information to third parties without proper and specific authority unless there is a legal or professional right or duty to disclose. Confidential information acquired as a result of professional and business relationships should not be based for the personal advantage of the professional accountant or third parties. The last principle is professional behavior. An accountant should comply with relevant laws and regulations and should avoid any action that discredits the profession. Then I am going to explain about the stages of accounting cycle. Accounting follows sequential steps in completing the operation and to fulfill its objectives. The required steps may be identified as follows. Step 1 is identification transaction data. Step 2 is recording transaction data through journal entries. Step 3 is preparing ledger accounts. Step 4 is preparing trial balances. Then step 5 is providing necessary adjusting entries. Then step 6 is preparation of financial statements. Step 3 is providing closing entries. Then step 8 includes preparation of post-closing trial balances. And finally, in step 9, you have to give reversing entries. Then last issue of this chapter is integrated reporting. General financial reporting emphasizes only on providing financial information to the users. However, integrated reporting is a modern approach to corporate reporting that combines both financial and non-financial information in a single report. It shows how an organization creates value over time by connecting its strategies, governance, performance, and future outlook with financial data, environmental impact, and social responsibilities. Instead of just showing numbers, integrated reporting provides a holistic view of a company, how it uses resources, interacts with society, and plans for sustainable value creation. For example, a company may not only report profit, but also how it manages employees, natural resources, technology, and customer relationships to ensure long-term process is a part of integrated reporting. So, an integrated report is a concise communication about an organization's strategy, governance, performance, and prospects in the context of its external environment, led to creation of value in the short, medium, and long term. This is a process founded on integrated thinking that results in a periodic integrated report by an organization about value creation over time and related communications regarding aspects of value creation. In screen, you can see the different components of integrated reporting that a company should disclose. The components are organizational overview and external environment, and under this aspect, the company should disclose the organization's mission and vision, key quantitative information, significant factors affecting the external environment and the organization's responses. Then it should disclose about the governance issues like organization's leadership structure, a specific process and particular actions, remuneration and incentives for the board members and the top management. Then you have to provide information about the business model. That means what are the inputs, the business activities section, the outputs and outcomes of the business. Then you have to provide information about risk and opportunities, the specific sources of risk and opportunities, the organization's assessment of risk, and the specific steps taken to managing those risks. Then you have to provide information about the strategy and resource allocation, that is the organization's strategic objectives, the resource allocation plan, and the linkage between them. Then you have to also disclose the performance of your organization. You have to provide information about qualitative indicators on targets and risk, the organization's effect on capitals, the state of key stakeholders' relationships, linkage with past and future performance. Then you have to provide information about the organization's expectations and how the organization is equipped to face them, the discussion of potential implications for future financial performance. And then you have to provide information about the basis of preparation and presentation of financial statements. That means the organization's materiality process, the description of reporting boundary, and frameworks and method used to quantify or evaluate material matters. And finally, you have to provide general reporting and guidance. For example, you have to provide information regarding disclosure of material matters, disclosure about the capitals, time for short, medium, and long-term information, and aggregation and disaggregation. That's all for today. Stay curious and don't be afraid to practice. Mistakes are part of learning. See you in the next class. Thank you.